Hello friends, welcome back to JK Shah classes of Vedanta Enterprise. Today we will be revising this chapter Income from Other Sources. It is chapter 4F. Chapter 4F Income from Other Source, IFOS, popularly called as 4 sections, section 56, 57, 58, 59. Now 4F, first of all, if you recollect, chapter 4A is salary, then there is to be one chapter 4B, income from interest, which was deleted long back in 1970s. Then chapter 4C, house property, chapter 4D, PGBP, 4E, capital gain, and 4F, income from other sources. IFHP and salary are deleted officially by institute from CA final direct tax. Inter CA it continues. So starting with IFOS, 56, 57, 58, 59, 4 section. Very first section talks about which incomes are taxable under this head. This is charging section. 56 is charging section. 57, 58 talk about expenditure which are allowable is 57 and not allowable are 58. And last section is unimportant, deemed profit, same as section 41(1) of PGBP chapter. Income which will be deemed to be considered or deemed to be income. Which incomes are taxable under this head? So this is the residuary head of income. Any income which is not taxable under the head salary, IFHP, PGBP, capital gain will be taxable under this head 56(1). 56(1) and 56(2). Now 56(2) clarifies which all incomes will be taxable under this head. 56(2) very first income is this is in the nature of example. But remember one fundamental thing, only those incomes will come under this head which are not taxable under other heads. Any income which is eligible to be taxed under other head will be given first priority. For example, this first income, interest on security. Security would include bonds, debentures, government security. However, PGBP chapter will be given first priority over IFOS. When will PGBP chapter apply for interest on security? If securities are held as closing stock in trade, then interest will be taxable under the PGBP. If not held as stock in trade, held as investment, then only interest will come under this particular head. Second is rental income from letting out of plant, machinery, furniture. Again, if this is the main activity of the assessee, this is what is the business, then income will be taxed under the head PGBP. Here it will come only if it is a kind of casual transaction. Composite rent or inseparable composite rent. Composite rent means combined rent. So this is a situation where the tenant wants property, tenant wants land building along with other assets, that is along with furniture, fitting, etc. Like cinema theater building, where the tenant is not ready to accept only 4 walls and 1 roof. He is not ready to accept it in a bare shell form. Along with building, along with cinema theater, he wants chairs, projector, screen, sound system, everything. Then combined rent, composite rent will be taxable under IFOS, whether bifurcation is available or not available. Say building rent is 10 lakh rupees per month and other assets rent is 5 lakh rupee per month. Total is 15 lakh rupee. Entire 15 lakh will be taxed under IFOS. Logically, building rent should go under the head IFHP and other assets rent should go under the head IFOS. But if it is inseparable means a situation where tenant is not ready to accept either of them without the other one. Tenant is not ready to accept only building without other assets, or tenant is not ready to accept other assets without building. Whether there is a separate agreement, rental agreement is separate for both of them or combined together. If tenant is not ready to accept both separately, then combined rent will be taxable under IFOS. Composite rent of cinema, theater building or restaurant, coaching class, etc. Next income is dividend. Dividend we may receive from foreign company, Indian company, that is domestic company, or we may receive dividend from cooperative society. Dividend will always be taxed under this head, come what may be. Even if shares are held as stock in trade, then also dividend will not go under the head PGBP. Including deemed dividend under 222E, 222A, B, C, D, E, F. 222F newly introduced, that is buyback of shares, which we will be studying separately. Important point. This chapter, all these incomes which we are discussing are ordinary incomes which you will offer to tax under the other source only, come what may be. So even if you go without studying also, dividend you know it is IFOS. In this chapter mainly we have to study two things: gift transaction, gift subject to 22 exceptions. Marriage received upon on the occasion of marriage, received from relative, on the death of the donor, gift, and second is dividend or deemed dividend concept. There are 5 types of deemed dividends. Now one more added in the bandwagon. Total 6 types of deemed dividends are there, which we will be discussing. Okay, dividend, whether it is real dividend or deemed dividend, both will be falling under this head. Final dividend as well as interim dividend, equity share dividend as well as preference shares dividend, or real dividend or deemed dividend. Fifth one is unimportant. As an employer, if you receive contribution from employee for depositing in his employee's provident fund account, as far as employee's provident fund account is concerned, employer also contributes. This is employer's contribution, 3,000 per month. So I am the employer, I pay 30,000 salary to employee, plus I deposit 3,000 in his employee's provident fund account. My total outflow is 33,000. I will get deduction for 33,000 in my business income. However, employee also wants to contribute 3,000. If employee wants to contribute, employee cannot contribute directly to this account. Employee cannot have an access to this account till he retires. So employee, he will have to give 3,000 to employer, and then employer will deposit that 3,000 in this account. So this 3,000 employee's contribution flows through employer, passes through employer. In such situation, on paper, employer pays full salary to employee, and then employer pays full salary to employee, then employee refunds back 3,000 per month, or whatever amount is decided. This 3,000 returned back by employee to employer will be deemed to be income of employer. First you add 3,000 to employer's income, and then when employer passes it on or deposits in his employee's provident fund account, whether you call it as RPF account or EPF account, then he will get deduction of that 3,000. So this 3,000 add 3,000 less will have a contra entry. Right now we are discussing 56(2), which is titled as which incomes taxable under this head. Section 56 is a charging section, so this 3,000 right now will be added to the income of the employer. Sum received by employer as a contribution from his employee towards staff welfare scheme. Right now add 3,000, later on 3,000 will be deducted. 3,000 will be added under section 56, which we are doing right now, and 3,000 will be deducted under section 57 when we come to that. So actually what happens is, in reality, employer never pays full 30,000. It's only on paper that employer paid 30,000 to employee, and then employee refunded back 3,000. That never happens. What happens in real life is employer will pay only 27,000 to save time, money, energy. Whatever may be the arrangement, simply amount received from employee towards his contribution will be added as an income of employer, later on will be deducted. Same thing we discussed in PGBP chapter also. So some of you might feel that why this head, this should be under PGBP. Answer, absolutely right. If this employee is my employee for my business or profession, then this entire amount will go under the head PGBP. But if employee is not for my business profession, if employee is for my investment head or it is for my IFOS head, then everything whatever we discussed in PGBP chapter will be taxable under this head. So this 3,000 priority will be given to PGBP head. PGBP head fails, then it will be taxable under this head. Okay, then the fifth is done. Sixth, Keyman insurance policy maturity proceeds including bonus. This is unimportant, it never comes in the exam. This is life insurance policy, but not a regular life insurance policy. It is a special Keyman insurance policy whereby the person, for example, Amitabh Bachchan, he is a key person of a company called ABCL, Amitabh Bachchan Corporation Limited. In this organization, Amitabh Bachchan plays a key role. He is a key person. If his premium he himself pays, then that's a regular policy. But his policy premium is paid by ABCL, then that's a Keyman insurance policy. Whatever premium paid will be allowed as a deduction under the head PGBP to ABCL and not under ATC. It will be allowed as a deduction under the head PGBP, fully allowed. Later on when the policy matures, depending upon in whose hands the policy will mature, policy can mature ideally in the hands of ABCL. If in their hand it matures, the maturity proceeds will be Not eligible for exemption under 1010D, maturity proceeds of Keyman insurance policy is always fully taxable. Not exempt, therefore fully taxable. If received by ABCL, then taxable under the PGBP. If it was assigned to Amitabh Bachchan receives it, then it will be taxable under the salary because he was an employee of ABCL or he is an employee of ABCL. But in case if it matures in the hands of family members, Jaya Bachchan or family member of Amitabh Bachchan, then taxable under IFOS. This I have clarified it here. So I have taken example of Ekta Kapoor. In case you have heard her name, Ekta Kapoor is so in case of normal policy, which we call as regular policy, insured person in whose name the person on whose life the policy is taken out is Ekta Kapoor. She runs this company called Balaji Telefilms, which is a public listed company, but she is the key person. She only runs the company. So premium is paid by Ekta Kapoor herself, then that is regular policy. Person in whose name the policy is there, he or her makes the payment of premium, then it is regular policy. Now in whose hands the maturity proceeds, the policy will mature. If something happens to Ekta Kapoor, she dies, then family members will receive. Family members receive, then it is exempt. 1010 under section 1010D, fully exempt. But if she herself receives it, then also it is eligible for exemption under 1010D. But in case if she paid premium more than 10% of policy sum, then in such situation it may be taxable under the IFOS if it is taxable. But as far as Keyman insurance policy is concerned, it is such a policy where policy is in the name of Ekta Kapoor, the key person, but the premiums are paid by Balaji Telefilms. Here if the policy matures in the hands of Balaji Telefilms, something happens to Ekta Kapoor, policy will mature. Something happens means if she dies, then it will be taxable in the hands of Balaji Telefilms under the PGBP. Here 1010D exemption is never available. If nothing happens to her, she survives, 20-25 years are over, policy has matured, policy tenure is over, then policy was assigned to her, then she would receive. If she receives, then taxable under the salary because she was an employee of the company. She was a CEO, come CMD, managing director. If received by family member, which is possible if the policy was assigned by Balaji Telefilms to Ekta Kapoor and now she dies, then policy maturity will be in the hands of family member, taxable under IFOS. So IFOS head will come only when it is Keyman insurance policy and receive maturity is in the hands of family member instead of Ekta Kapoor herself or Balaji Telefilms. Okay. Then casual income, which is an important point. This obviously without studying also you will be answering it this way. Casual income would mean once in a while income, not having recurring nature, like winning from lottery, crossword puzzle, card game, winning from online games, rummy circle, etc. or winning from any race including horse race will all be taxable under this head. However, subject to condition that deduction will not be allowed for any expenditure incurred for earning such income, 58 subsection 4, which we will be discussing in this chapter only. Gross amount will be taxable, and also refer to chapter 12 special rates of tax, section 115BB and 115BBJ, whereby these winning incomes will be taxable at a flat rate of 30%. And also we discuss the same concept under the TDS 194B and BB. 194B is TDS 30% from winning from lottery, crossword puzzle, card game or any other game, or winning from any activity in the nature of gambling or betting. And 194BB TDS 30% from winning from horse race. 56 subsection 2 clause 10, the most important part of the chapter, gift transaction. Here 56 subsection 2 clause 10 has 3 subclauses, subclause A, subclause B and subclause C. Subclause A talks about receipt of money exceeding 50,000. Whether it is received by cash or account payee check, account payee draft or normal check, regular check, whatever may be the mode of receipt, if it is money exceeding 50,000 received without consideration, without anything in return, then that will be taxable, subject to 22 exceptions. In 22 exceptional cases, gift is not taxable. If it is up to 49,999 or up to 50,000 rupees per annum, then nothing will be taxable. If it exceeds 50,000, then entire amount will be taxable. So I received 17,000 from 3 friends three friends, 51,000 in totality, entire 51,000 will be taxable and not just the amount exceeding 50,000. Clause B and clause C, they talk about taxability of immovable property, whether it is residential or commercial property, whether it is only land, only building, land plus building, commercial, residential, any kind of immovable property. Two possibilities: immovable property is either received free of cost, that is without consideration, then entire value will be taxable. Second possibility, received at less than stamp duty value, means received for inadequate consideration, purchase for inadequate consideration. Here the stamp duty value is, for example, is 180 lakh, 1 crore 80 lakh rupees worth of flat I received free of cost, then entire 1 crore 80 lakh will be taxable. And here stamp duty value is 1 crore 80 lakh and I got it for amount paid by me to acquire the flat, of course subject to exception, is only 120 lakh. Then whatever is the benefit to me, here what is the benefit if I receive free of cost? If I receive free of cost, then entire value is the benefit for me. And if I receive 180 lakh worth of flat for 120 lakh, then my benefit is 60. Whatever is the benefit, no friends, that much will be taxable. It's a simple rule, right? Don't use your brain much. Of course, subject to condition that stamp duty value should be more than 50,000 and here benefit amount should be more than 50,000. There are some other points also which we will discuss. This is synopsis of three clauses, index you can call it as. Same way for movable property. Movable property here would not mean each and every movable property. There are 8 specific assets, 8 plus 1. Now virtual digital asset is also included, 9 assets which are covered here. Concept applies or taxability will apply only for receiving of these 9 assets, any of these 9 assets. Does not apply to anything other than this. Motor car is not one of these 9 assets. If I receive 10 lakh rupee worth of motor car for 6 lakhs second hand car, then 4 lakh is my benefit. 4 lakhs nothing will be taxable because this asset is not covered here. Movable property may be received like immovable property, either free of cost or that is without consideration or for less than market value, inadequate consideration. If market value here is 2 lakh rupees, then entire 2 lakh is taxable because my benefit is 2 lakh rupee. 2 lakh rupee worth of item I received for 0, though my benefit is 2 lakh rupees, 2 lakh taxable. And here for inadequate consideration, so market value is 2 lakh rupees and I got it for 20,000. Then my benefit, how much is the benefit to me? 1 lakh 80. So amount taxable will be 1 lakh 80,000. 180 will be taxable, that is the concept. However, we will be discussing all three one by one, starting with 56 subsection 2 clause 10 subclause A. Money, receipt of money, any person receiving from any person. Earlier, once upon a time, till 2016-17, till previous government was there, it was taxable only in the hands of recipient being individual or HUF. Now, since past 7-8 years, it is taxable if anybody receiving from anybody, company receives from shareholder, anybody receiving from anybody taxable, but which asset? Money, and that too exceeding 50,000 rupees. 50,000 is in aggregate, means in totality. It is not 50,000 per transaction. Receipt by any person without any consideration from any person. Receipt by any person from any person. Okay. Then 56 subsection 2 clause 10 subclause B. Receipt of immovable property, residential or commercial, receipt by any person from any person, subject to 22 exceptions which we will be discussing, could be land, building or both. Okay. However, here two possibilities, receipt without consideration, receipt for inadequate consideration. So, if the stamp duty value of such property exceeds 50,000 rupees, then entire stamp duty value will be taxable, and in case receipt without consideration, then full amount. If receipt for inadequate consideration, then only difference amount taxable. Immovable property is receipt for consideration and consideration paid is less than the stamp duty value of such property, and the consideration and the stamp duty value difference between the two is more than 50,000 plus it is more than 10% also of the consideration, then the difference will be taxable. Stamp duty value of such property, the excess will be taxable over consideration. Let us try to understand with the help of few examples. Stamp duty value should exceed 10% of the difference between the two should be more than 10% of actual consideration, meaning thereby stamp duty value should exceed 110% of the actual. If actual is 100 then stamp duty value should be more than 110. Stamp duty value should be more than 110. More than 110, meaning thereby it should be 111 and so and so. Let's try to understand with the help of few examples. Actual purchase consideration is this much, stamp duty value is this much, difference between the two is this much. So actual consideration is 100, stamp duty value is 106, difference is 6 lakhs. Check whether this difference is more than 50,000 or not. Answer yes. Check if the difference is more than 10% of actual or not. Is this 6 lakhs more than 10% of 100? Answer no. 6 lakhs is just 6% of actual actual purchase consideration. It is 6%. The answer is no. No, then nothing would be taxable here. If answer to both these columns is yes, yes, then only answer to third column will be yes. If the difference is 107, stamp duty value is 7, then difference is more than 50,000 but not exceeding 10%, then taxability will not arise. Difference is 8 lakh, stamp duty value is 108, then difference is more than 50,000 but not more than 10%. Same thing for next point also. Accordingly, taxability will not arise. Only in this situation, understand very carefully, stamp duty value is 111, difference is 11, difference is more than 50,000 as well as it is more than 10% of 100. Both the answer is yes, yes, then taxability will be arising. How much will be taxable? Answer entire difference 11 lakh will be taxable, whatever is the difference. However, if the difference is exactly 10%, as in this case, it is more than 50,000, but it is it exceeding 50,000? Is it exceeding 10%? Answer no, it is not exceeding 10%, it is exactly 10%, therefore not exceeding 10%, therefore taxability will not arise. However, if the actual purchase consideration is 4 lakh, stamp duty value is 4 lakh 48, difference is 48,000. 48,000 is more than 10% of 4 lakh, 10% condition is fulfilled, but more than 50,000, difference should be more than 50,000 also. This condition is not fulfilled, taxability will not arise. You can take a screenshot of this particular slide. You can pause the video, or you can pause the video and copy this down, or you can take a screenshot. I will proceed further. Okay. Next is 56 subsection 2 clause C, subclause C, section 56 subsection 2 clause 10 subclause C, receipt of movable property. However, this is applicable only on 9 specific assets. Number 1, shares and securities. Number 2, jewelry. Then archaeological collections, drawings, paintings, sculptures, work of art, bullion and virtual digital asset. Virtual digital asset as in cryptocurrency, Bitcoin, etc. Not to any other asset. Another clarification, that provided these 9 assets are forming part of stock in trade and not forming part of stock in trade, then only. If it is forming part of stock in trade, for example jewelry, or let's say bullion. Bullion means raw form of gold, silver, etc. Gold coin, silver coin, etc. Suppose I am a jeweler. 20 lakh rupee worth of gold I receive for 19 lakh. Because I am a jeweler, I buy it in a bulk quantity, so I may receive. And then I am going to sell it. Let's say I sold it for 20. I sold it for 20 lakh. 1 lakh rupee is going to be taxed for me under the PGBP otherwise also. Will I be taxed for this 20 lakh worth of item I received for 19? Will I be taxed for this 1 lakh under the IFOS also? Answer no. Therefore, because this is stock in trade. So, this concept is applicable for these 9 assets. Taxability will arise only if the given item is not stock in trade for the recipient. Because if it is stock in trade, it would be taxed otherwise also. Whenever actually sold, it will be taxed under the PGBP also. Okay, now here 2 possibilities: receipt free of cost without consideration or receipt for inadequate consideration. If receipt for without consideration, then the market value should exceed 50,000. For money, amount of money should exceed 50,000. For immovable property, stamp duty value should exceed 50,000. Movable property, FMV should exceed 50,000. Exceed 50,000, then entire FMV will be taxable. And in case if receipt without consideration, then entire FMV. But if receipt for inadequate consideration, then benefit amount, the difference between market value and the amount paid, difference should be more than 50,000 and only difference will be taxable. Excess of FMV over such actual consideration will be taxed. Provided these assets, first of all, concept applicable only to these 9 assets, and land, building, land plus building, 3 types of immovable property, 9 types of movable property. Once question came in the exam at inter CA level that motor car is received, 10 lakh worth of motor car receipt for 6 lakhs. Answer, differential 4 lakh will not be taxable because motor car is not one of the asset covered here. That 4 lakh will go untaxed. Okay. Provided these assets do not form part of stock in trade raw material or consumables, do not form part of so and so. In other words, it should form part of capital asset or investment in the hands of recipient. Then only it will apply. Why is it like this? I explain it to you. Concept does not apply to any other asset. In a tabular form, we can do it this way. Any person receiving immovable property, movable property. Again, two bifurcation. Immovable property received without consideration, we receive for inadequate consideration. Movable property received without consideration, receipt for inadequate consideration. For movable property, we consider market value FMV, and for immovable property, we have to take stamp duty value into consideration. If received without consideration, let's start with movable property, received without consideration, and the aggregate FMV of such property or properties is greater than 50,000. Aggregate FMV is greater than 50,000. Entire FMV will be taxable. Here, aggregate FMV is to be checked. Aggregate means total FMV. So, if I receive multiple items, I received jewelry also, bullion also, work of art also, 3-4 items from maybe same person or different people. I have to merge everything combined together. Aggregate FMV of all of them should exceed 50,000. 50,000 is not a threshold limit, it's a kind of qualifying amount. Sorry, it's not a qualifying amount, it's a threshold limit, meaning thereby once it exceeds 50,000, entire amount including first 50,000 will be taxable. If received for inadequate consideration, then the difference will be taxable. Difference will be taxable, entire difference, provided difference amount is more than 50,000. Okay, as far as immovable property is concerned, starting with without consideration, first situation, if immovable property received without consideration, whether commercial or residential, whether land, building or land plus building, stamp duty value of such property exceeds 50,000, then entire stamp duty value will be taxable. But if received without consideration, then this receipt for inadequate consideration, then we have to check difference between stamp duty value and the amount paid. Stamp duty value should be more, amount paid should be less, then only assessee is benefited, benefit should be there. Consideration paid by assessee and to acquire it is less than stamp duty value of such property, and difference between the two is more than higher of following two. In fact, in my language, the difference between the two should be, I would say, not higher than following two. In my language, it should be difference should be more than both the following. Number one, difference should be more than 50,000, as well as difference should be more than 10% of such consideration, 10% of actual consideration paid to acquire it, then entire difference will be taxable. Whenever received without consideration, then full value will be taxable. Whenever received for inadequate consideration, then difference will be taxable, provided difference is more than 50,000. Okay. Now, we need to understand one very important fact here, very important thing. As far as movable assets are concerned, it is very clearly given aggregate FMV of such property or properties, aggregate FMV of such property or properties. So, for movable property, we have to consider combined value of multiple movable assets received in 1 year. So is not the thing, or so is not a language for immovable property. For immovable property, it says the stamp duty value of such property. Here also stamp duty value of such property. Both the places it is such property, meaning thereby here 50,000 difference amount is for each property individually, whereas for movable property 50,000 is a combined difference for all movable assets received in 1 year. Of course, only 9 assets whatever are covered here, concept does not apply to any other asset other than these 9 assets. Notes: for movable property we have to take FMV, for stamp duty value we have to take stamp duty value. For immovable property stamp duty value, movable assets FMV. FMV as on what date? To answer, FMV as on the date of receipt. Keep it in your mind, it should be as on the date of receipt. However, as far as immovable property is concerned, we have to take stamp duty value. Stamp duty value as on what date? There are multiple dates possible with regards to immovable property. Number one, the date on which token amount was paid or the advance was paid. Number two, the date on which allotment letter is issued in case you are buying in an under construction property. Third is the date on which full payment is made. Fourth is the date on which possession is received. Fifth is the date on which sale agreement is executed. Sixth, the date on which stamp duty is paid and the property is registered, registration charge is paid. Out of these, which date to be taken into account? So different dates very difficult to identify. So government has, as a one-time solution, government has kept the date of registration. Stamp duty value shall be as on the date of registration of such property with the registrar of property. However, normally registration date is later and the date of agreement is earlier. I entered into purchase agreement on day 1 and then I received possession after maybe 6 months after making full payment, especially when it is an under construction property. So what happens is, here we end up taking stamp duty value as on the date of registration, but date of registration would be later. In such situation, option is given to the assessee that if the date of registration and the date of property and the date of agreement are not the same, then instead of taking stamp duty value as on the date of registration, which is a later date, here the stamp duty value could be higher amount as compared to stamp duty value on the date of agreement. Of course, stamp duty values don't keep changing every year, but if there is a considerable time gap, then stamp duty value, there is an upward revision by state government every 2-3 years. In Maharashtra, it is every 2 years 5%. If dates are not same, date of agreement, date of registration, then assessee instead of stamp duty value date or the stamp duty value on the date of registration, one can take stamp duty value on the date of agreement provided condition is satisfied. What is the condition? Here assessee is a buyer. Same condition just like section 50C in PGBP chapter as we discussed and section 43CA for capital gain chapter. What is the condition? Condition is, here these two sections were applicable to seller. So we say condition is at least some amount of consideration is received by way of account payee check, account payee draft. Here this section is applicable for buyer, the person who purchases the property. The language is same but opposite. Here instead of stamp duty value as on the date of registration, one can take into account stamp duty value as on the date of agreement, that is old stamp duty value, provided some amount of consideration was paid otherwise by way of account payee, otherwise by way of cash. That means account payee check paid by way of account payee check, account payee draft, electronic clearing service through a bank, ECS or prescribed electronic mode. Some amount was paid on or before the date of agreement by way of account payee check, account payee draft, ECS or prescribed electronic mode on or before the date of agreement. Stamp duty value can be taken into account only when stamp duty value is more than 110% of the actual consideration, or you can say the difference between the two is more than 10% of actual consideration. Okay. If stamp duty value is disputed by assessee, many a times what happens is stamp duty value is decided area wise. State government decides area wise. So many a times what happens is in assessee's building stamp duty value is high as per area, as per location, as per locality, but assessee's building was in a dilapidated condition, very old building. For example, in Mumbai particular area, rate per square feet is 1 lakh rupee in that area. 1 lakh rupee per square feet is the rate, but my building it fetches 60,000 because my building is an old building, is in a slightly dilapidated condition, cannot fetch the same rate which other properties in a nearby vicinity can fetch. So in such situation what to do? By default stamp duty value will be taken into account, which is area wise. My value, then do I have to compulsorily pay tax on the differential amount? Answer no, don't worry. File IT return showing 60,000. Let AO object to this. Moment AO objects, assessee can request AO to refer the matter to valuation officer, who's a VO, valuation officer of department, also called as departmental valuation officer, DVO. DVO will personally come and inspect the property. He will verify whether it genuinely can fetch 60,000 or not, or it can fetch 1 lakh rupee. Assessee is lying or assessee is genuine. VO will physically come and verify. VO will visit nearby vicinity also. VO will speak to some people. VO will go to registrar's office and will find out whether this property can fetch 1 lakh or 60,000. In such situation, section 155 subsection 15 rectification of mistake read with section 50C, provisions of 50C will apply. Okay. In such situation, value ultimately, what will be the value taken into account? Answer, either the value reported by valuation officer in his report by VO or the stamp duty value, whichever is less will be taken into account. So my sale consideration is 60 lakhs, but in my area it fetches the rate of 120 lakh. This is stamp duty value. I genuinely sold it for 60 lakh, this is actual. The matter goes to assessee requested AO that please refer to VO, AO referred the matter to VO. VO will physically come and inspect the property, he will give his report. VO will prepare his valuation report. According to VO, if the value is 60, then matter over 60 will be accepted. VO says 120, 120 will be accepted, but if VO says value is 80 lakhs, neither 60 nor 120, correct value is 80, 80 will be adopted. However, VO's value, valuation officer's value should not exceed the stamp duty value. If VO says correct value is, I repeat, evaluation officer says according to VO, this is stamp duty value, according to VO value is 180 lakhs, then thus such order cannot be passed, he has to restrict himself to stamp duty value. His valuation should not be more than this. For example, amount paid, different examples, amount paid to acquire the property is 100 in all the example, 1, 2, 3, 4, 5, all the 5 examples amount paid is 100, stamp duty value is different, stamp duty value is 180, 180, 180, 180, last one it is 111. Value as per departmental valuation officer is 200, 120, 100, 80, 104. This is changing in all the 5 situations. Which value will be taken into account? To answer, first of all find out of these two, whichever is lower, out of these two, lower of these two, VO's value or stamp duty value, which one is lower? Answer, lower of the two is 180. 180 you compare with 100, actual, whichever is higher, 180. However, according to assessee, assessee is paid 100, according to stamp duty value, the value should be 180, but according to valuation officer, the value should be 120. So, very first step, 120 versus 180, whichever is lower, so 120, 120 versus 100, amount paid to acquire is 100. So, value to be taken into account will be, which value will be taken into account? Answer, 180, whichever is higher, sorry, 120. Out of these two, whichever is lower, lower of the two is 120, 120 or 100, whichever is higher, 120. Third example, according to assessee, he has sold it for 100, stamp duty value is 180, valuation officer says 100, then in such situation, first step, 180 versus 100, whichever is lower, 100, 100 versus 100, whichever is higher, 100 will be taken into account. Fourth example, according to VO, it is 80. Such order VO will not pass, but in such situation, 180 or 80, whichever is lower, 80, 80 versus 100, whichever is higher, 100. And last example, 100 and 111. Here the stamp duty value has changed as compared to previous 4 examples, 111. But AO referred to VO, VO says 104, 104 versus 111, whichever is lower, 104, 104 versus 100, whichever is higher, 104 will be taken into account. 180, 120, this. Even if 4 lakh rupees of difference does not match up with the condition of 10% of actual consideration, we know, we discussed that stamp duty value should be 110%, stamp duty value should be 110% of actual, then only stamp duty value will be taken into account. That rule will not apply here. Why? Because that rule is applicable only for stamp duty value. That rule is not for value determined by valuation officer. There are some exceptions, 22 exceptions. Out of them, only first 8 plus 1, 9 are relevant. Remaining all, that is remaining 13 are totally unimportant, governed by various clauses of section 47. This was introduced by government later on. Earlier there were only these 8 exceptions. Now 8 exceptions have become, original 8 exceptions have become 9 exceptions, plus government introduced couple of more exceptions which are covered by various sections, various clauses of section 47. Like for example, section 47 clause 3, gift transaction. Gift transaction will not be taxable in the hands of recipient of the gift, will not be taxable in hands of donee, and donor also will not get deduction. It will be personal gift, no? However, following receipts of money, immovable, movable property shall not be regarded as transfer or shall not be regarded as income in the hands of recipient. shall not be regarded as an income in the hands of recipient. First exception, very important, receipt from relative. What is the definition of relative? What do we mean by relative? That is clarified here. Normally, relative is defined in section 2 clause 15, 2 clause 41 of the Act, but that definition not to be applied. Here relative is specifically defined. If receipt from relative, second receipt on the occasion of marriage, then clarification, marriage would mean only assessee's own marriage and not his family member's marriage, and only marriage, no other function like 25th anniversary celebration, 50th anniversary celebration, or marriage anniversary is not covered, only marriage is covered. Marriage anniversary will come every year. Give receipt upon marriage anniversary will be taxable. Engagement function, birthday party function, completion of anniversary of engagement function, anniversary of marriage function, all these items not covered. Only and only exception is marriage, and that too only marriage, no other function. Marriage of the assessee himself, exemption for the receipt, exemption is for the person getting the gift. Number 1, technically following 22 exception. Number 1, receipt by way of will in this was number 1, relative. Second is marriage. Third, first two are important. Third is also important. Received upon will or inheritance, received as per will of the deceased, meaning thereby here somebody has died, somebody has passed away, that senior citizen from whom you inherited property, the senior citizen has passed away. Contemplation of death of the payer or the donor. Donor is about to die, maybe he has become brain dead and now before his death he already passed on something to him, or person is about to die, he is ill-aged, old-aged person, when he is staying very ill, likely to die any moment, before he suffers Parkinson's, stroke or Alzheimer, he decided to execute will and gift away everything to you in your hands. It will not be taxed because it is in contemplation of death. That does not mean the donor has to actually die. Even if he does not die, exemption will be available. Or receipt from local authority, municipality. Okay. Then next point and next to next point are 5th and 6th point. Those public charitable trust institutions which are registered under section 12A or 12AA or 12AB, or those fund, foundation, university, educational qualification, hospital or a medical institution which is approved or referred to in 1023C, then those people will be exempted. Received by trust, from trust, both the direction exemption is provided, meaning thereby you took loan from public charitable trust, not loan, you took financial aid, you took 1 lakh rupees of financial aid from, let us say, any charitable institution, then whether that should be taxable or not. So answer, first of all, receipt from or receipt by, two-way direction, meaning thereby you receiving from trust, or trust receiving from you, receipt by trust from you, then both the way it will not be taxable in the hands of either of them. Okay, 8th one, give receipt which is not regarded as transfer as per section 47. There are total 22 items. This is one item out of total 22 items. This is not one. Whatever numbers are, whatever items are covered here, they are also being counted. So technically, how many situations we are done with? We are done with first 7 markings I have already given you, plus in the 8th point there are around 16 points. 47 clause 1, asset transferred by HUF to member receiving it from receipt of asset by member as a result of total or partial partition. Received by Indian subsidiary company from its holding company. Subsidiary company is receiving, this company is paying. So in such situation, received by Indian subsidiary or forming, received by subsidiary from holding company. Next is the vice versa, 47 clause 14, received by subsidiary company is this way only, received by subsidiary from holding. Here receipt of an asset by Indian holding company to subsidiary company. Holding company transferring to subsidiary company. Subsidiary company is a recipient. It will not be regarded as transfer. With regards to amalgamation merger, we have couple of points which we have already done in capital gain chapter. You can kindly have a look at them. We have covered quite a few many points in capital gain chapter. Okay. Receipt from such class of persons and subject to such conditions as may be prescribed. Up till now, only one item is prescribed, that is COVID time, Corona. So, number 1, receipt by an individual. This is only for individual. Individual, receipt by individual from any person in respect of any expenditure actually incurred by him on his medical treatment or medical treatment of his family members. Then for any illness related to COVID-19, then subject to conditions notified by government, then in such situation taxability will not arise. For individual, mediclaim or medical treatment of his family member, individual receives during Corona 2020, during Corona period, somebody receives, is Mr. K. Let us say is Ketan Parekh. He received, Mr. Ketan, he fell sick. During Corona, he was hospitalized. During that period, he ended up spending 35 lakh rupees. Now, he had to sell off his flat, or he had pledged his flat with a bank. Now, somebody came forward, like Devendra Fadnavis ji came forward and gave him compensation of 40 lakh rupees plus constructed a new house. In such situation, Ketan will not be taxed because received during illness related to COVID-19. It should be relating to COVID-19. Ketan was hospitalized. He had severe medical problem, and because of that he had to incur 35 lakh rupees. Any medical issue due to illness related to COVID-19, and 35 lakh rupees is received by him from Mr. X. That 35 lakh, nothing will be taxed even if it is more than 50,000. However, 11 point also you need to understand, both are in relation to COVID-19. Here, any person received from any person, received by an individual, not even HUF, received by individual from any other person who are not covered here in respect of expenditure for actually incurred by him or medical treatment or on medical treatment of any of his family members, COVID-19 during that period. Then this is in case that person is alive. And he undergoes medical treatment. What if he dies? If the person was an employee working somewhere and he dies, then employer might come forward and pay some compensation to the family members of deceased employee. If that is what happens, then receipt by family, that is what happens, then next point, 12 point, right now 11. Receipt by family member of the deceased person agreed from the employer or of the deceased person, receipt from house property, receipt from any other person exceeding 10 lakh. Again relating to COVID-19, but here assessee is dying, person is dying. 10th point, no one is dying, it's just that person is provided with medical treatment. Unimportant, if you have understood, well and good, not understood, then even better. For example, somebody fell sick because of COVID attack. He had to be taken to, from Mumbai, he had to be taken to Bengaluru for heart transplantation or maybe lungs transplantation, what do you call it as. Then concept will not apply irrespective of amount. Taxability will not arise irrespective of the amount involved. However, on the other hand, if the person dies, here he is alive, he himself receives. If he dies, family members may receive. Family members receiving from the employer, ex-employer of the husband, then unlimited amount will be exempt. If received from any other person, bank, etc., then up to 10 lakh rupee per annum will be applicable, provided death is on or after particular date. The death is because of COVID-19, doctor's certificate should be there, and payment is received within 12 months from the end of the death of the person. This is an important condition. Claim should have been lodged within 12 months from the date of such death and subject to fulfillment of other condition. So, after introduction of this point, today you try to claim that 2 years back I had received loan, nothing, or I had received compensation from so and so party, nothing doing, taxable. Okay, point 10 and point number 11, both the places we use the word family. Family. And this point number 12 also we are using the word family, receipt by family member. So family, what will come under family, what will not come? So that I have already explained to you. Okay, but it says family means the word family shall have the same meaning which is given in section 11 or sorry section 10 clause 5 leave travel allowance, where if you recollect, assessee and his spouse and maximum 2 children can travel anywhere in the country, and then whatever is the travel expenditure, government will give fixed compensation. Okay, shall have the same meaning and shall include spouse and children, whether dependent on the individual or not, and dependent parents, brother, sister who are wholly or mainly dependent on the individual. Relative for the purpose of claiming this exemption with regards to COVID-19 related amount. Who all are the exceptions? Exception is also unimportant. Exception is in the form of definition of family. If you take, family would include spouse, children, dependent parents, dependent brother, dependent sister. I call it as Bahujan Samajwadi Party, BSP, brother, sister, parent, spouse, children. Okay. Now explanation to 56 subsection 2. Now the question is, what do you mean by relative? Relative is one of the exception. For individual, the word relative will have a different meaning, and for HUF, the relative word will have a slightly different meaning. Individual, if the assessee, that is recipient, individual means recipient is individual, then it will include following 7 people. Number 1, spouse of the individual. Then 3 types of brothers, sisters. Spouse, that is husband, wife, etc. Life partner. 3 types of brother, sister. Own brother, sister of the spouse, brother, sister of the either of the parents. Parents would mean mother or father, father's brother, sister, mother's brother, sister, both will be included. 3 types of brother, sister. Then any linearly ascendant or linearly descendant of the individual himself. Lineal means straight line, linearly ascendant, that is father, grandfather, great grandfather. Linearly descendant means son, grandson, great grandson, or daughter, granddaughter, great granddaughter. Or linearly ascendant or descendant of the spouse of the individual, and last, spouse of the any of the above covered by point number B2F, spouse of persons covered by B2F. Okay, understand who all are not covered. Cousins are not covered. Brother, sister would mean real brother, sister and not cousin. That's one thing. Secondly, all types of brother, sisters are covered, but not cousins. That is what you need to remember. And in case, as far as maternal parents are concerned, maternal parents, here if I am the individual, my own father, grandfather, great grandfather are covered, and the spouse of father, grandfather, great grandfather, means father will be falling under this point, my own father. My mother will fall under this category. My mother is not linearly ascendant. Ascendant means only male ancestors. Mother is a spouse of the father. Mother will fall under point number G. Then grandfather will fall under point number E. Grandmother will form part of point number G. It is to be understood that way. Great grandfather, great grandmother. However, my father, my grandfather, my great grandfather means father's father, father's father's father. However, mother's father and mother's father's father are not covered. My own linearly ascendant descendant and my spouse's ascendant descendants are covered. My mother's ascendant descendants are not covered. And if the recipient is HUF, then any member of HUF will be relative. Okay, this is over. Cousins are not covered, nephew, niece are not covered, uncle, aunt of the spouse are not covered, nana, nani not covered. In Hindi, nana, nani means maternal grandparents. Maternal grandparents are called nana, nani in Hindi, and paternal grandparents are called dada, dadi. It's a Hindi word. In English, we call everyone as grandfather, grandmother, nanny, whatever you call it. Okay, next is 56 subsection 2 clause 7b called angel tax, where it was private company which is deleted now from AY 25-26 onwards for reasons not difficult to understand. Private company receiving money as share application for issue of shares, money for issue of its shares, and that amount received for issue of shares is greater than face value as well as greater than FMV of such shares, then amount exceeding FMV was taxable. Then amendments were carried out in this section, finally deleted by government one fine day. So that is done. This is deleted. Why have I covered here along with this proviso? And because once upon a time it was applicable, so some people who are studying after a gap, they might be searching for it. Why is angel tax not covered? So answer, this tax is used to be called as angel tax popularly, but removed now. Applicable mainly for startup companies. Then there was some exception. 56 subsection 2 clause 8, important from exam perspective, interest, but not each and every interest. Interest on delayed compensation or enhanced compensation will be taxable under this head, subject to standard deduction under section 57 clause 4 to the tune of 50% of such interest. Other than standard deduction, no other expenses will be allowed, and according to section 145B, which we studied in assessment procedure chapter, this interest will be taxable in the year of receipt only, irrespective of method of accounting followed by assessee. 50% standard deduction, against that no other actual expenditure will be allowed. Then 56 subsection 2 clause 9, something pertaining to capital gain chapter. In capital gain chapter, if you recollect, advance forfeited, advance money is received for sale of any asset, movable, immovable, any asset, advance money is received. Such advance is forfeited and negotiations do not result into transfer of capital asset to the same person, then advance forfeited will now be 100% taxable in the year of forfeiture. It will be taxable under the head IFOS. Earlier it was section 51, it was governed by section 51 up to 31st March 2014. Because of some inherent defect in that section is still there, applicable in case if advance was received up to 31st March 14. New government introduced this, if advance is forfeited on or after 1st April 2014, then it will be taxable under the head income from other sources. In which year? It will be taxable in the year of, under this head, in the year of forfeiture, whether it is called by advance money or earnest money, token amount, advance money, by any other name. Earlier section 51 was applicable up to AY 14-15. Now this 56 subsection 2 clause 11, this is totally useless, introduced by Arun Jaitley ji in AY 16-17, but nobody understands what is it for. It says that any compensation or any other payment by whatever name called, ideally compensation, received by a person or due from any person in connection with termination of employment or modification of terms conditions of employment will be taxable under this head. Now exactly this payment is covered by salary head also. Salary is no more applicable at final CS stage as a perquisite under section 17 subsection 3, it is not perquisite as profit in lieu of salary for termination of employment. However, so what is this and what is this? Where will it be taxed? Answer, if it is received from employer, then it will be taxed under this, under the head salary, and if it is received from any other person, for example, I am working with Coca-Cola and Coca-Cola only pays me for modifying my agreement, employment agreement, then will be taxable under the head salary. But if I receive it from competitor Pepsi, that take 50 lakh rupees, I am very much in demand, take 50 lakh rupees, leave Pepsi, join Coca-Cola, then termination of employment received from third party, then taxable under this head. 56(2)(12). This is in connection with business trust, introduced in AY 24-25. Business trust has unit holder, if you recollect. Business trust can be of two types, REIT, Real Estate Investment Trust, or InvIT, Infrastructure Investment Trust. Where do they invest? We know pretty well, we have done this chapter. Now whether it is REIT or InvIT makes no difference. Business trust paying money to unit holder, paying money, then it is taxable under the respective head, under pass-through status. We have discussed this. Some incomes taxable for business trust and some incomes are taxable for unit holder. Whatever is exempt for business trust, that is taxable for unit holder. We have studied this. Answer, we are not discussing about that income. If business trust passes on some money to unit holder which is in the nature of capital contribution repayment, repayment of initial contribution made by unit holder, which is neither taxable in the hands of business trust nor taxable in the hands of unit holder, then such amount will now be taxable under this head. However, how much will be taxable? So answer, amount taxable will be amount received above and over the initial contribution. Amount received by unit holder from the business trust will be taxed under the head IFOS in the hands of unit holder. How much will be taxable? The amount received above and over the amount contributed by unit holder. So unit holder had paid 100 rupee per unit to business trust and he receives 20 rupees, the 20 not taxable. Later he received 40 rupees, total has become 60, still nothing taxable. Again 60 rupee received, total received becomes 120. Now 120 minus 100, 20 rupee will be taxable. Amount taxable will be the amount received over and above what he had contributed. Now this calculation is to be made from the perspective of not unit holder but from the perspective of business trust. Formula is given A minus B minus C. If negative, then it shall be understood as 0. What is A? A means amount paid by business trust, amount paid to unit holder, minus B is equal to amount received from unit holder, amount received for issue of units, issue of units. What is C? I will tell you in a moment. Paid to unit holder, amount paid by business trust to the unit holder. For example, 120 rupees is paid minus amount received from unit holder, amount received was 100, then 20 rupee will be taxable. If it becomes negative, then ignore it. What is C? C means, before we jump to C, understand A here would mean not only the amount paid right now, amount here paid to the unit holder would include amount paid to the earlier unit holder also, current unit holder also, whether paid in the current year, paid in the earlier year, paid 10 years back, everything. Total amount paid by business trust to the unit holder up till now minus amount which was received by business trust from the unit holder for issue of units. What is C? C means amount already taxed earlier. Already taxed earlier, that is called point A. So point A is aggregate sum distributed by business trust, amount paid by business trust to the unit holder in respect of such units, either during the previous year or any earlier previous year or previous years. Amount distributed in the current year, right now, earlier, or any earlier previous year or multiple years to such unit holder who holds such units right now on the date of distribution or who held such units in the past at any time prior to date of distribution. Simple language, total amount paid by business trust to unit holder in the past, in the current year, all combined together, total, whether paid to the same unit holder or earlier unit holder or earlier to earlier unit holder, total amount paid to all or any of the unit holder combined together, provided such amount is not in the nature of incomes referred to in 1023 FC, 1023 FC or 1023 FCA. 1023 FC subclause A means interest received by business trust from SPV, special purpose vehicle, and 1023 FC subclause B, there are two subclauses to section 1023C. Dividend received by business trust from SPV, and 1023 FCA means rental income received from letting out of real estate assets which are directly owned by business trust. These two items are exempt in the hands of business trust and are taxable for unit holder. So it says item, if it is not in the nature of this income, it should not be an income which is exempt for business trust, and it is not even chargeable to tax under 115 US subsection 2 in the hands of business trust. This seems to be some blunder on the part of Nirmala Sitharamanji. Ideally this should have been 115 UA subsection 1. Okay, she wants to say which is neither exempt in the hands of business trust nor is it taxable in the hands of unit holder. But instead of that, she introduced A and B, which is neither. What is point A? Point A is something which is not exempt in the hands of business trust. Something which is not exempt in the hands of business trust, and clause 2 is something which is not taxable also. Everyone is still wondering what is such income, what is such amount which is neither taxable for business trust nor is it exempt for business trust. Ideally, Nirmala Sitharamanji is talking about capital repayment. So you are unit holder, I am business trust, you contributed 100 rupee. If I pay you something from recurring income which I earned from your 100 rupee, that income could be either taxable for you or taxable for me. Not talking about that income. What is repaid to you, what is paid to you is something out of your contribution only, then that is called as neither exempt nor taxable. However, that is possible to the tune of what you had contributed, 100 rupee. Beyond that, above and over 100, whatever I will pay you has to come from recurring income or my regular income, which is either taxable for you or taxable for me, either of us, under pass-through status. But something will come out of that income, no? Everything cannot be out of capital contribution. Amount which I repay back to you out of capital contribution can be only to the tune of original 100. B point, amount at which unit was issued by the business trust. It doesn't say how much you had paid. You might have original unit holder contributed 100 rupee. I received 100 rupee. Amount at which unit was issued is 100 rupee. You might have purchased from somebody from the secondary market at 200 rupee. What you paid, that is not to be taken into account. What unit holder paid, not to be taken into account. What business trust had received, that is what is to be taken into account. And C point, amount already taxed in any earlier previous year. If it becomes negative, it shall be taken as 0. Let me explain it to you with one example. Suppose in A minus B minus C. So first instance, you had contributed 100 rupee. I paid you 20. I had received 100 from you and nothing has been taxed up till now. Then it becomes negative 80. Negative 80, then ignore it, make it 0. Then I paid you 40 rupees. So if I pay you 40 rupees, then plus 20 rupees. Earlier amount will also have to be taken into account. A would be 60. Minus 100, minus nothing has been taxed in the past. Still answer is negative 40. Negative 40, ignore it, 0. Third possibility, again I paid you 20. Amount received by you, amount paid by me to you or to next person or whatever is 40 plus 20 plus furthermore 20. Total amount paid is 80. 80 minus 100 received by me minus nothing has been taxed. Still answer is negative 20. Make it 0. Nothing will be taxable. Fourth possibility, up till now I have already paid you 100. I have paid you 80. Therefore nothing was taxed in your hand. Now I am paying you 50 rupees more. So now 50 plus earlier 80, total I have paid you 130. Or maybe you sold off the units to somebody. You received 80 rupees up till now. Now you sold off the unit to somebody, Mr. X, and now I am paying 50 rupees. So Mr. X will receive 50. How much total I have paid? Total I have paid till now is 130. 130 minus 100 minus 0. Nothing has been taxed up till now. Amount taxable for Mr. X who receives 50 rupees from me, out of 50, 30 rupee will be taxable. 130 minus 100. However, understand, next time again I am distributing 10 rupee. I am distributing 10 rupee. So 10 rupee plus amount distributed till now 130 till previous transaction. Total 140 I have distributed. 140 minus 100. What I had received from you. What I had received for issuing units. 40 should be taxable, but how much has been already taxed earlier? 30 rupees has been taxed earlier, so now 10 rupee will be taxed. Next occasion, again I distributed 20 rupees further. So 20 I am distributing now, 140 I already distributed earlier. Total amount distributed by me is 160 minus I had received 100 rupee for issuing units. So technically 60 rupees should be taxed. A minus B is 60, but amount already taxed is 40 rupees. Amount already taxed is 40, subtract 40. The amount now taxed will be 20. Simply anything which I pay you above and over 100 will be taxed in your hands. Okay, this is 56 subsection 2 clause 12, newly introduced from AY 24-25. Question hasn't come yet on this, question expected anytime. It's very simple, it can come in the form of MCQ. 56 subsection 2 clause 13, again introduced last year, AY 24-25. This is maturity proceeds of life insurance policy. We know pretty well maturity proceeds of life insurance policy, if it is KIP, Keyman insurance policy, it is fully taxed, fully taxable, no formula needs to be applied, fully taxable under the head either PGBP, salary or IFOS. If taxable under IFOS, it will be taxed under this section. Then if it is other than KIP, other policy, regular, other normal policy, then up till now it was taxable only if not exempt. If not exempt under section 1010D. When will it not be exempt under 1010D for a regular policy? Two possibility. Chidambaram ji had introduced in 2003 that annual premium exceeds 20% of the sum assured, which he brought down to 10% later on, or later on he increased it to 15% for those people who are suffering from disability given in 80U or disease given in 80DDB. So as of now 10% and 15% are applicable. Annual premium exceeds 10% or 15% of sum assured, SA. Now came Nirmala Sitharaman ji. Nirmala Sitharaman ji from 1st April 23, she said taxable, but up till now we were planning to tax rich people, those who are paying exorbitant amount of premium. But in terms of, according to Chidambaram ji, the exorbitant premium would mean premium is more than particular percentage of sum assured. But Nirmala Sitharaman ji, she changed it that okay, it should be means high premium policy. Ideally what was getting taxed was high premium policy, but high premium policy used to be understood as those policies by Chidambaram, those policies where premium is high, but premium is high in terms of percentage. Nirmala Sitharaman ji said no, even if premium is more than 5 lakh rupees per annum, why should it be in terms of percentage? Why can't it be in terms of amount? So Nirmala Sitharaman ji introduced this new clause that if the annual premium is more than 5 lakh but policy is issued on or after 1st April 23, concept not applicable for old policy, concept applicable only for newly introduced policy, then this taxability will arise. In either case, there will be TDS under section 194DA that we will discuss in TDS chapter. 2% TDS will be there or 5%. However, something will be taxable here. How much will be taxable? So answer, maturity proceeds received. Maturity proceeds including bonus is 42 lakhs. Premium paid up till now. Premium paid up till now is 40 lakhs. So logically how much should be taxable? Naturally entire 42 cannot be taxed. It's a matter of common sense. Entire 42 cannot be taxed. Amount taxable, some people logically thought 42 minus whatever premium paid. It's like I am making investment in bank FD. I have put 40 lakhs up till now and now I am receiving 42. So ideally 2 lakhs should be taxed. Nirmala Sitharaman ji said no, not 42 minus 40. Amount taxable will be this 42 amount received. Whether maturity proceeds including bonus amount received minus premiums paid till now minus deduction already claimed under ATC or under any other provision for the premium paid. Deduction, so amount received is 42 minus premiums paid are 40 lakhs minus deduction claim under any provision of the Act. Say deduction claim up till now was 1.5 lakhs per annum, 1.5 lakhs per annum into 20 years under old scheme, old tax regime. So 40 lakhs minus 30 lakhs was already claimed as deduction and now 42 lakhs is received. So taxable amount will be 12 lakhs. No. 42 lakhs minus 10 lakhs is equal to 32 lakh. 32 lakh will be taxable and not 2 lakhs. What Nirmala Sitharaman ji said is that don't deduct only 40. You should be getting deduction of 40. You have paid premium 40, you should get deduction of 40. She said yes, you should get deduction of 40. But out of 40, you have already claimed deduction. 40 should be subtracted. No? 42 is received minus 40, your income should be 2. You should get deduction of 40. You should get deduction of 40. Out of 40, 1.5 lakh per annum into 20 years under section 80C, you have already claimed 30 lakhs. 30 lakhs is already claimed. Since 30 lakhs is already claimed, this 30 should not be allowed to be subtracted again. Otherwise, there will be 30 lakhs claimed twice. So this 30 you reduce and balance is 40 lakhs, balance is 10 lakhs, 10 lakhs you now claim. 30 lakhs already claimed, 10 lakhs yet to be claimed. Simply whatever deductions you have not claimed out of 40 lakh, 40 you have a right to claim. But out of 40, whatever is already claimed, your right is gone. Now you have a right to claim 10 lakhs. So 42 minus 10 lakhs you now claim, 32 will be taxable. Getting this point? Why the provision is like this? Okay, maturity proceeds including bonus of life insurance policy other than ULIP and other than Keyman insurance. For ULIP will be taxable, maturity proceeds will be taxable under the capital gain. Section 45 1B, which those who have already watched the revision lecture of capital gain, they must be knowing. Those who have yet to watch, please go and refer to it. Very nicely explained by me. Amount taxable will be equal to maturity proceeds including bonus received 42 lakhs less aggregate premiums paid on such LIP 40 lakhs minus deduction already claimed for such premium under any provision of Income Tax Act. Deduction already claimed is 30 lakhs. This was just an illustration. It's not necessary that assessee might have claimed full 30 lakhs. He might have claimed, every year he might not have claimed 1.5 lakh. See, every year he might have claimed lesser amount. He might have claimed only 50,000, whatever. Whatever is already claimed, you lose your right to claim that much again. That is the whole idea. Clear? Okay. Then I have taken one example here. Particular LIP not eligible for exemption, maturity proceeds is 70 lakh. This is what is received. Premiums paid are 6 lakhs per annum into 10 years. 60 lakhs is a premium paid. So logically you would feel 70 minus 60, 10 lakhs is received above and over. 10 lakhs is received above and over what you had invested. So 10 lakhs should be taxable. Answer no. But you already claimed deduction under 80C 1.5 lakh per annum into 10 years. 15 lakhs was claimed as a deduction. 15 lakhs already claimed, that much you claim less now. Or in other words, 15 lakh you add to your answer. Taxable amount 25 lakh. Okay, so maturity proceeds is 70 lakh minus premiums already paid 60 lakh minus chapter 6 deduction claim 15 lakhs. So 70 minus 45, your taxable amount will be 25. Simply whatever deduction was already claimed, that needs to be added back. Okay, when will maturity proceeds not be exempt? So it could be either because of annual premium exceeding particular percentage or annual premium exceeding 5 lakh rupees. So if it is unit linked insurance policy, ULIP, then taxability is under the capital gain section 45 1B. If it is Keyman insurance policy, it could be taxed, we discussed today only, could be taxed under the PGBP if received by Balaji Telefilms, could be taxed under the salary if received by Ekta Kapoor, the key person, or could be taxed under the IFOS if received by family members of Ekta Kapoor. Or if it is any other insurance policy other than the above two, we call it as a regular policy, then taxable under this section 56 subsection 2 clause 13. Okay. Now some points to be noted about these incomes. These incomes under IFOS are taxable under the head IFOS according to section 145 subsection 1 depending upon method of accounting. Assessee following cash system or mercantile system. Mercantile is also called as accrual system. Taxability will be according to his system of accounting except of two incomes, except of two incomes which I have covered here, this point, except of dividend income and interest on delayed or enhanced compensation. These two incomes are always taxable on receipt basis. As per for these two incomes, your method of accounting does not play any role. Dividend income according to section 8 will be taxable either at the time of due, whenever it becomes due, always at the time when it becomes due, and not at the time when received, irrespective of your method of accounting, even if you are following cash system. And interest on delayed compensation as per 145B always taxable on receipt basis, irrespective of your method of accounting. So here if you are following accrual system, then also taxable at the time of receipt. And for dividend income, even if you are following cash system, still it will be taxable whenever it becomes due, whenever it is announced by company. And this point was, first point was, two incomes are always taxable under this head and never under the head PGBP. Dividend income and winning income. Winning from lottery, crossword puzzle, card game, gambling, betting, races. Gambling income, winning income always taxable under IFOS, come what may be. Okay, this you remember. Now with that, this first part of the chapter is over, which all incomes are specifically covered. Now the remaining part, which other incomes are taxable under this head, including deemed dividend under section 222 to 222, 222A to 222E and plus 222F, and deductions allowable under section 57, deductions not allowed under section 58. These three items will be primarily be discussing in the second half, that is second part of this chapter. Today first part I am ending here. See you in the second part very soon. Thank you.